Welcome everyone to the Deep Dive, and a really special welcome to all of you tuning in on the One More Bitcoin channel. Today we're doing a deep dive into something, well, absolutely critical. A huge shift happening in global payments. We're talking about a real giant SWIFT, the 50-year-old titan of cross-border finance. Well, it seems they're finally deciding to embrace the future.
Yeah, and when you look at the material, specifically that extensive report from the One More Money blog, the one titled The Payment Giant's Bold Pivot, Swift Shopping Move into the Blockchain World, it's clear this isn't just some minor upgrade. It really feels more like a response to an existential crisis.
Exactly.
So our mission today is really to unpack that report. The blog describes Swift's transition perfectly, I think. They call it the dinosaur learns to skateboard.
Huh. I love that metaphor. It just perfectly captures how difficult, how almost awkward this kind of move must be for an institution like SWIFT. So, here's the plan. We'll cover SWIFT's long legacy, then dig into the threats like stablecoins and CBDCs that forced its hand. Then we'll look at the actual tech strategy, like why they chose Linea, the blockchain platform. And finally, the big one, what this all means for investment in crypto, RWA, and DeFi. Ready to jump in? Let's start with understanding this giant SWIFT itself.
Okay, so SWIFT, that's the Society for Worldwide Interbank Financial Telecommunication. It's basically the definition of global banking infrastructure, for decades anyway. It connects, over 11,000 financial institutions? Banks, mainly.
Wow, 11,000.
Yeah, across more than 200 countries and territories. If you're sending money internationally, especially bank to bank, the instructions almost certainly travel via SWIFT.
And this is a really crucial point. The One More Money blog makes very clear, SWIFT isn't actually moving the money itself. It's a messaging system.
Exactly. Think of it like a super secure global email system just for banks. It carries the payment instruction, the sort of memo, saying, hey, this money needs to move from bank A to bank B.
Right. But the actual settlement, the money changing hands, that still relies on this older system, correspondent banking.
Precisely. And that's where the problems start, the cracks in the foundation, as the blog calls them. This legacy system creates a lot of friction. We're talking settlement times of typically 3 to 5 business days for cross-border payments.
3 to 5 days in 2025. It's just completely out of step with the real-time global economy we live in now.
Totally. And it's expensive, too.
Yeah.
Because that single message, that instruction, might have to hop between several intermediary banks in the correspondent network.
And each one takes a slice of the pie.
You got it. Each one takes a cut. The One More Money blog notes that transfers often cost $20 to $50, sometimes even more.
That might not sound like a lot for one transfer, but imagine you're a corporation doing hundreds or thousands of these.
Exactly. For corporate treasuries dealing with high volumes, those fees become a serious drag on margins. It adds up incredibly fast.
And there's another angle too, isn't there? The centralization risk.
Yeah, that's fascinating. What used to be its strength, centralized control, is now seen as a major vulnerability. SWIFT basically holds a geopolitical kill switch. We saw this very dramatically with the removal of Russian banks back in 2022.
Right.
That single action showed the whole world that relying on this one centralized system carries huge political risk. It basically lit a fire under nations to find alternatives, ways to bypass it.
So the inertia, the sort of we've always done it this way attitude after 50 years, it's finally hitting a wall. Because the alternatives, like tokenization, are just getting so much better, faster and cheaper.
Absolutely. Which supports the idea from the One More Money blog that this evolution from SWIFT is largely reactive, not necessarily some grand vision, but more like they were forced into it.
Backed into a corner by these existential threats?
Yeah, the threats were becoming undeniable. The biggest one, probably the stablecoin surge. I mean, the market cap now is, it's over $300 billion as of October 2025?
$300 billion. Wow.
And these stablecoins offer near-instant settlement, permissionless, often, and crucially, super low-cost settlement. They're basically eating SWIFT's lunch on both speed and price.
The One More Money blog had that killer cost comparison example. It really drives the point home.
Oh yeah, the arbitrage example. It's stark.
Walk us through it again.
Okay, so imagine a company making, say, 100 international payments of $100,000 each every month. Via SWIFT, even if you lowball the fee at $50 per payment, that's $5,000 a month just in fees.
Okay.
Now, do that same volume using regulated stablecoins on a modern blockchain. The total cost for all 100 payments might be maybe $1, sometimes less.
$1 versus $5,000.
Exactly. The difference isn't just marginal, it's massive. Right. It practically mandates that businesses look for alternatives.
And if stablecoins were enough pressure.
Right. Then you have the looming presence of CBDCs, central bank digital currencies. The stats are pretty wild. Over 90% of central banks globally are now actively researching or piloting CBDCs.
90%.
Yeah. And projects like Enbridge, which involves multiple central banks, are specifically designed for direct cross-border CBDC payments. If Enbridge or something similar succeeds, it could completely bypass the need for correspondent banks in those corridors.
Which would make SWIFT's messaging role, well, potentially obsolete for those flows.
Precisely. Huge threat.
So all this pressure leads us to the shocking move, as the blog calls it. The formal announcement date was 29 September 2025. SWIFT announced it would add a blockchain-based shared ledger. Why? To support real-time, 247 cross-border payments using regulated tokenized value.
It's a massive pivot, a fundamental change in their business model.
How so?
They're moving from being just a messaging layer.
The secure email system.
Right. To becoming a hybrid messaging plus settlement ledger operator. They realized sending messages about money isn't enough anymore. They need to be involved in the actual movement, the settlement itself.
So the strategy is defense. Defend their relevance.
Partly, yes. Defend their core relevance, absolutely. Prevent being disintermediated, but also capture some of that settlement revenue they were missing out on.
Makes sense. And compete head-on with stablecoins.
Or rather, integrate them. Plan for a future where stablecoins and bank-issued tokens are part of their ecosystem.
Okay. And become the bridge.
Exactly. The regulated bridge. Connecting traditional finance, TradFi, to this new tokenized economy, RWAs, digital securities, all of it. Be the safe, compliant on-ramp.
So how are they actually building this? What's the tech blueprint look like, according to the One More Money blog?
Well, the key word seems to be fusion, not rupture. They're not ripping out the old SWIFT system overnight.
That would be chaos.
Total chaos. Instead, they're adding this new permission-shared ledger layer alongside the existing rails, so banks can migrate gradually.
Smart. And they're not doing it alone.
No. They partnered with ConsenSys for the initial pilot phases.
Yeah.
And they brought in over 30 major global financial institutions to collaborate and test it out. Big names involved.
Okay, let's talk about the platform choice, because this was maybe the most surprising part. They picked Linea,
Yeah.
which is an Ethereum Layer-2, an L2, using ZK EVM architecture. Why not just build their own private bank-only blockchain? Why tie themselves to Ethereum with all its, public chain baggage?
That's the million-dollar question, isn't it?
Yeah.
And it shows some real strategic thinking, I believe. Building a totally private chain risks creating another silo, another closed system that doesn't talk to anything else.
Right.
Might become obsolete quickly.
Okay.
By choosing Linea and Ethereum L2, they get the best of both worlds, sort of. They tap into Ethereum security, its massive developer base, its battle-tested infrastructure.
But without the mainnet's congestion and high fees.
Exactly. The Layer 2 solution, Linea in this case, handles the scaling. And the specific tech, ZK-EVM, is key.
Right, ZK EVM. Break that down for us again. Why is that the magic ingredient for banks?
Okay, so ZK-EVM is zero-knowledge Ethereum virtual machine. The EVM part means it's compatible with Ethereum's tools and language. That's huge for integration. Banks can use familiar stuff.
Makes adoption easier.
Much easier. The ZK part, zero-knowledge proofs. That's the privacy piece institutions absolutely need. It lets banks prove that a transaction on the blockchain is valid and correct without revealing the sensitive details, who sent what to whom, how much.
So you get the transparency and auditability of a blockchain, but maintain the confidentiality that banking requires.
Precisely. It's a clever balance.
And the cost savings are significant too, right? The One More Money blog mentioned Linea being much cheaper than mainnet Ethereum.
Yeah, potentially something like 115th of the cost of mainnet fees. That makes running high volumes of transactions economically feasible in a way that mainnet just isn't for this kind of application.
Okay, and another critical detail from the blog, SWIFT isn't creating its own cryptocurrency, right? No SWIFT coin?
Correct. No native token. This is really important. They are positioning themselves purely as neutral infrastructure. They operate the rails. They don't issue the currency moving on them.
Keeps things cleaner, less regulatory headache, maybe.
Definitely seems like part of the calculation. And to avoid being just another silo, they're using Chainlink's CCIP.
The cross-chain interoperability protocol, what does that do for them?
It's the glue. CCIP ensures that their new consortium chain can securely communicate and transact with other chains, stablecoin networks, maybe other L2s, public blockchains, even future CBDC systems.
So it's not just a SWIFT island, it's designed to connect outwards.
Absolutely vital for it to be accepted globally. Interoperability is non-negotiable.
Okay, stepping back. The potential impact here feels enormous. If SWIFT pulls this off, what are the biggest changes we'll see?
Well, the obvious one is cross-border payments becoming instant or near instant. And 247, that alone is revolutionary for banks,
Goodbye, 3 for 5 business days.
hopefully. And the cost savings for banks could be huge. The blog estimates potential savings of 50 to 70% on their cross-border operations. That flows straight to the bottom line.
50 to 70%, that's massive profit margin potential.
It really is. And think about the scale. SWIFT currently processes messaging for, what, an estimated $150 trillion in value annually.
Staggering number.
Now, imagine even a small fraction of that underlying value actually moving, settling on these new L2 rails like Linea. The demand shift for the Ethereum L2 ecosystem, Linea, maybe others like Arbitrum, Optimism, could be explosive. It can totally revalue these networks.
So for our listeners, for you trying to navigate this space, what are the key investment signals the One More Money blog highlights? What should we be watching?
Okay, signal one is clearly L2 ecosystem demand. This move by SWIFT is a massive validation for Layer 2 scaling solutions. So keep a close eye on the whole L2 space. Activity on Linea, obviously, but also other established L2s could benefit from this rising tide.
And tactically?
Tactically, you absolutely have to watch for any news about a native Linea token. If that launches, it's positioned to directly capture value from these institutional flows SWIFT is bringing.
Got it. L2's in focus. What's signal 2?
Signal 2 is about stablecoins and tokenized banking. SWIFT adopting this tech confers huge legitimacy. It basically confirms that regulated stablecoins, especially the institution-focused ones like USDC or maybe bank-issued tokens, are becoming core financial infrastructure. They're not just crypto experiments anymore.
On the infrastructure providers.
Right. Like Chainlink. Their selection with CCIP reinforces their role. Chainlink isn't just about price feeds. It's becoming the secure interoperability layer connecting TradFi and DeFi. Its importance just went up another notch.
Okay. And the third signal?
Signal 3 is focused on digital-first banks. Those institutions that are early adopters, think players like JP Morgan, BNY Mellon, others who are already experimenting heavily with tokenization. They stand to gain a real competitive advantage. If they integrate these new rails effectively, the cost savings we talked about could significantly boost their profit margins compared to slower-moving competitors.
So watch the banks that embrace this tech versus the ones that lag behind.
Exactly. It could create a clear performance gap.
Now, we've talked a lot about the potential upside, but this is a huge, complex undertaking. Let's bring in some critical perspective. What are the major risks and challenges SWIFT faces in actually executing this pivot?
Oh, the risks are substantial. This is high stakes. Maybe the biggest hurdle is legal finality.
Legal finality, explain that.
Okay, so a blockchain can give you technical validity, the transaction is recorded, immutable on the ledger, done. But legal finality is different. It's a legal concept. Does that blockchain entry hold up in court in every single country involved? Is it truly irreversible from a legal standpoint?
So if something goes wrong, like a bank involved goes bankrupt.
Exactly. Who legally owns that tokenized asset on the SWIFT ledger? The laws just aren't fully settled globally for this kind of system yet. It's a massive legal gray area that needs resolving across jurisdictions.
That sounds incredibly complex. What else?
Regulatory uncertainty. It's a minefield. You got the U.S. still debating crypto rules, Europe rolling out its MiCA framework, different approaches in Asia. It's a patchwork. If one major economic bloc imposes rules that are incompatible or bans certain types of stablecoins SWIFT plans to use, it could seriously derail the whole project's global adoption.
Right, the system needs regulatory harmony to work smoothly everywhere.
Definitely. And then there's just the sheer integration complexity. You're trying to merge a 50-year-old system, likely running on mainframes and older tech, with cutting-edge blockchain technology.
The dinosaur learns to skateboard problem again.
Precisely. It's like trying to bolt a Formula One engine onto a vintage car. The operational risks, the security risks of connecting these systems, getting the timing right across thousands of banks.
Yeah.
It's enormous. It demands near flawless execution.
Okay, so significant hurdles remain. But despite these risks, the One More Money blog ends with this interesting vision of the future, right? Not one system wins, but maybe 3 coexist, the 3 kingdoms idea.
Yeah, I thought that was a really insightful way to frame it. It suggests coexistence and interoperability, not a winner-takes-all scenario.
So what are the 3 kingdoms?
Kingdom 1 is basically SWIFT's new consortium chain. This becomes the home for the high-value regulated bank-to-bank tokenized payments, the new backbone for the big players.
Okay, the regulated core, Kingdom 2.
Kingdom 2 would be the fintech and specific payment rail networks. Think players like Ripple or Stellar. They might focus on different niches, consumer remittances, specific currency corridors. Lower value payments, perhaps?
Right, specialized players. And the third kingdom.
That's the Wild West, in a way. Public blockchains, DeFi, and the broader tokenized finance ecosystem. This is where the permissionless innovation happens, the new financial products emerge.
And the crucial point is that these three kingdoms won't exist in total isolation.
Exactly. The key takeaway is that the bridges between them, those interoperability protocols like Chainlink, CCIP, become incredibly important. They're the diplomatic envoys, the trade routes connecting these different financial realms. SWIFT isn't aiming to conquer the other kingdoms, just connect to them.
Makes sense. A multi-chain interconnected future.
That seems to be the most likely outcome. And SWIFT's big pivot, it's fundamentally a defensive strategy, yes, but it's also a massive confirmation from the heart of the traditional system that, like it or not, tokenization and real-time digital rails are the future of finance. So for you, the listener, the path to understanding, maybe finding that alpha, lies in really watching which infrastructure layers gain traction, which assets get regulatory blessing, and how these different kingdoms learn to interact.
Great summary. Okay, just a quick standard note before we sign off. Please remember that trading cryptocurrencies, RWA, DeFi, and Bitcoin involves substantial risk and is not suitable for every investor. The information shared on this channel is for informational purposes only and does not constitute financial advice. Always do your own research. Thank you for watching this deep dive. We hope you found this look at SWIFT's big blockchain move useful. If you're interested in staying ahead on cryptocurrencies, RWA, DeFi, and Bitcoin investment, definitely make sure you subscribe to the One More Bitcoin channel right now. Hit that notification bell so you don't miss our future videos. And we genuinely want to know what you think. Will this SWIFT move accelerate crypto adoption? Heard it. Let us know your thoughts in the comments below and give us a like if you enjoyed the discussion. Thank you for watching again, and we'll see you in the next deep dive about blockchain, Bitcoin, and crypto.